up from the previous range. All is well here. The one thing, though, is, John, because of some of the litigation hanging over the company, the stock is down 10%. But with this sort of an outlook, who knows? Maybe it is on the move toward a more positive year.
It's up this morning, 3M, advancing by 3%. Abby, thank you for that. Spotify delivering a miss on revenue, to be specific, which overshadowed its monthly active user forecast that was better than expected thanks to younger listeners. Simone Foxman has more. Morning, Simone.
Morning, John. Yeah, those user numbers coming in really hot, stunning, Bloomberg intelligence for the like. But total active users up 551 million, especially because of Gen Z. However, those weaker financials really weighing on the stock this morning. Shares now down around 9% after falling substantially in the pre-market. Was that miss on revenue slightly below Wall Street's forecast as well as the company's own estimates? It was also the worries about the margins. Gross margin coming in at 24.1%. They've been hanging around that 24-25% level, even though the company in the long term wants to get to 30% gross margins. They're looking for 26% next quarter, but analysts not really sure how they're going to get there. We've seen a sell-off since July 19th. The sell-off that JP Morgan says is overdone, but when you look at gains this year, the stock's still up about 90%, so we'll see how traders try and parse all this data today.
Simone, thank you. On course if we close around these levels right now for the biggest one-day drop going back to December of last year, so worst performance of the year so far intraday. Spotify at the moment, fourth day of declines for that stock. I want to turn to the auto sector. GM out with earnings this morning. The car maker raising its outlook amid strengthening demand for its diesel-fueled SUVs. The CFO, Paul Jacobson, catching up with us a little bit earlier this morning.
I'm not sure that we're going to be able to raise prices across the board. We see a lot of stability in the market. We're just kind of taking it one day, 1 month at a time and watching the results come in. We've got to be focused on quality, and we've got to be focused on getting production in the vehicles that customers want.
Joining us now is David Welch, Bloomberg's very own. David, I have to say he sounded upbeat. Were there good reasons to be upbeat?
General Motors hit it out of the park in terms of beating estimates. They hit it out of the park in terms of raising guidance for the year, so they've got good demand. Prices actually increased first quarter to second quarter, and they're saying that's going to be stable. And we're talking about prices that are already at historically high levels. So the scene is all set for GM to make a lot of money. I still think that there's an overhang on the stock with investors that there could be a strike this fall, which last time it happened, it cost GM more than $2 billion. And I do think still there's kind of a wait and see on GM's electric vehicle program, which is kind of stuck in second gear at the moment. So, look, great performance from the company. They're cutting costs. They're growing market share on that old internal combustion side of the business, but there are a few things that investors, I think, are still taking a wait-and-see attitude about. Well, at least we're with pre-market trading for sure.
What would you point to right now based on the early price action? When the numbers came out, and they came out a little bit awkwardly, but we won't go over that now. Looking at the stock down by 4 or 5%, that's not what I expected when I first saw the numbers this morning.
Yeah, I do think because GM had such a great second quarter in terms of unit sales in the U.S., which drives most of their profitability, and that news was out early in July. So some of this was already baked in. Investors knew it was going to be a very good quarter in terms of selling trucks and SUVs where they make a lot of money. I do wonder if the fact that CEO Mary Barra specifically called out labor negotiations in her letter, if that sort of reinforced fears among investors that there could be a strike this year, that maybe thou doth protest too much about the market's fear of a labor contract year. And UAW President Sean Fain has had some pretty fiery rhetoric about negotiating with the big three and how much money they're making. I think there's some of that, and the EV story is still not fully baked enough at General Motors to garner a lot of enthusiasm, but it could also be just an issue of, okay, this is as good as it gets in terms of GM's profitability, and that's always kind of been an issue with the Detroit car makers. They have a great quarter, and Wall Street just doesn't believe there's much on the other end of the rainbow, so they don't really buy in.
Stock's down 4% right now. David, thanks for the update. David Welch there on the latest from General Motors. Let's turn to the home builders. What a bright spot so far this year in the equity market. Pulte Group topping profit and revenue forecast thanks to continuing demand for new homes homes. The CEO saying this: while there remains an extremely limited supply of existing homes, we have a much improved supply chain that has us well positioned to meet demand going forward. Katie has more. Hey, Katie.
Hey, John. Currently, you look at the stock market, shares are about 3% higher at this morning after, like you mentioned, Pulte Group beat on second quarter estimates. We're talking revenue, adjusted EPS, and homes closed all came in higher than estimates. However, unit backlog, it did increase to a value of $8.2 billion at the end of the second quarter. That's up from about a value of $7.9 billion at the end of the first quarter. Now, also, as you mentioned, CEO Ryan Marshall, he did say that Pulte Group is well positioned here to meet that demand going forward as existing home supply remains extremely limited. That's a similar message to what we heard from D.R. Horton just last week, that there's just not a lot of housing supply in this economy. And of course, that's been a tailwind for these home builders all year, really, from that demand standpoint. And now they have to continue to deliver that supply. Look at Pulte Group again, currently higher than 3%. For context, it's already up 76% so far this year.
Year-to-date gains are just phenomenal. It's just unreal to see what the home builders have done. Katie, thank you. Thank you for that. Krishna Mamani of Lafayette expecting the solid economic landscape to keep a floor under stocks and writing this: housing remains strong, manufacturing data is actually recovering. That and valuations will keep equities in a range, but makes the long end of the bond market very vulnerable, which in turn makes every part of the market very vulnerable. Krishna, I'm pleased to say, joins us now. So Krishna, let's get straight into it. The bond market, the 10-year right now is at 390. When you say vulnerable, what are you thinking here? 50 basis points, 100 basis points? Can you put a number on it?
Yes, I don't think it's 100 basis points. I think 4.5 is probably the top end of the range for 10-year. I think a couple of stories that you just talked about kind of highlight why the bonds, the long end of the bond market may be vulnerable, which is look at housing. Housing is doing spectacularly well, at least new construction, if not existing home sales. And I think in that sort of an environment, the risk of a re-acceleration in the economy is substantial. And I think it's that risk that makes the long end of the market far more vulnerable. The talk of a recession has been postponed, and it probably gets postponed even early 2024. So I think that's not the driver that can take rates lower. On the other hand, any whiff of a re-acceleration, and we get through 4% very quickly.
So Krishna, in the last 30 minutes, we caught up with PIMCO. Tiffany Wilding told us that student loan repayments resume later this year. We know that. She expects them to bite growth. She's looking for a deceleration in economic growth because of some of that and other things too. What would you push back against to say that's not the case?
Well, so I think that there are two basic kind of drivers there. One is employment. Employment is not showing any sign of slowing whatsoever. And as long as that is the case, real incomes are increasing, that supports consumption. So that's one thing. And the second thing is the cyclical part of the economy. Housing, for example, remains extraordinarily strong. And manufacturing, which we were counting on to kind of drive the slowdown in a potential recession, is kind of stabilizing. With all the fiscal stimulus that is still in the system and likely to remain in the system for an extended period of time, I don't think it's very unrealistic to expect a modest reacceleration. And a modest reacceleration is all we need for this, for the long end of the market to become very vulnerable.
So Krishna, is that good or bad for stocks?
Well, so I think stocks are okay because nominal growth is pretty high. And as long as that is the case, and we are still in a stimulative environment in terms of fiscal policy, I think stocks probably hold their own. They probably don't go to 4,800, 4,900 anytime soon, but I think they can hold this middle of 4,000s range for an extended period of time. I think if rates go meaningfully higher, then everything kind of becomes far more questionable. But at the moment, I don't think that is the case.
Do you anticipate that given what you're looking for, the chairman of the Federal Reserve has to manage that risk, and ultimately that could shape the message we get received from the chairman tomorrow in the news conference?
Well, I think first thing is they're going to tighten. Everyone knows that. But I think there is absolutely no reason for the chair to tone down anything. And that doesn't serve any purpose whatsoever, and he probably antagonizes a lot of people on the committee. So he's going to stay on message on that front. Whether they tighten in November or not, which is probably the next likely point, there's a lot of time to figure that out. irrespective of that, as inflation comes down, real rates are increasing. So that is doing a lot of the work of the Fed, even without them raising rates. So I think they're at a really good spot. Things are working out according to their plan. They just have to hold on to that particular position.
Krishna, how difficult do you think it is to keep everyone happy on that committee right now?
Well, so I think there are folks who are still very worried about inflation and the fact that core is not coming down soon enough, and the employment remains relatively robust. I think that certainly creates a bit of angst for certain of the members. But I think as inflation continues to come down, they can't really raise too much ruckus, because if they raise too much ruckus and as a result policies tighten significantly more, that increases the risk of the soft landing that everyone is hoping for, including the hawks.
Krishna Mamani of Lafayette College on the latest in this market and on the Federal Reserve. Krishna, thank you, sir, as always. Looking ahead to the Fed, that's tomorrow. That two-day meeting begins today. About 13 minutes into this session, we advance on the S&P. More recently, some underperformance in the NASDAQ over the last several days. Some outperformance today. The NASDAQ 100 higher by 0.4%. Coming up, a big afternoon for the NASDAQ. Looking ahead to big tech earnings with Microsoft and Alphabet after the close.
I think everybody that wants to start these initial rollouts of generative AI are paying a top dollar. This is a super cycle. I just think that we may be a little bit ahead of reality.
That conversation up next with Evercore's Mark Mahaney.
the rally is and has been certainly broadening out. And to be clear, through the spring, it was undoubtedly the so-called Magnificent Seven. I mean, there's a bit of revisionist history going on that somehow the broad rally has always been the case, that it's not just 7 stocks. For a long period of time, it was just 7 stocks. But you have a tremendous catch-up now on the part of small and mid caps, as we know, and the rest of the index is playing a bit of catch-up as well.
40% of the S&P 500 reporting earnings this week, a critical stretch for big tech, looking to justify their valuations following the Nasdaq's best first half on record. The results coming after the closing bell with Microsoft and Alphabet, then it's Meta's turn on Wednesday. Evercore's Mark Mahaney has outperformed ratings on both Meta and Alphabet, seeing Alphabet revenue in line with expectations and saying this: "We view the street's revenue estimate as reasonable, given our ad channel checks suggesting largely stable search ad spend growth, robust global travel demand, a potentially thawing ad winter, and FX turning to a tailwind." Mark Mahaney joins us now, Senior Managing Director at Evercore ISI. Mark, wonderful to do this with you as always. Ad spend is still the business at Google, so let's go there straight away. What are you looking for a little bit later?
Well, I think that quote you cited earlier is, I don't think there's any change in our view there. We're seeing these small bits and pieces of evidence that the ad demand is starting to improve, but they're really small. They're tentative pieces of evidence, and I'm not sure that Google is going to outplay that improvement. The checks we had showed that search growth was kind of stable in Q2, stable at a low level versus Q1. So there's still some work that needs to be done there. And then the company is still on the YouTube side of the business, has been working through a couple of, I think, execution issues recently, and is still a little bit lagging Meta in terms of responding to the Apple privacy changes and then the impact that that's had on performance marketing campaigns. So there's still more wood to chop with Google. What I think investors would love to see, leaving aside the ad revenue, is real signs of greater cost discipline. I'm not sure you're going to hear that from Google, though. So, Google for us is a small buy. Meta is one of our top 3 picks. Google, we'd prefer that over Google, even with the major rally in Meta shares year to date.
Before we get to Meta, Mark, just one more on Google, Alphabet and AI, if we can. You and I have heard so much from so many people about this AI investment cycle boom. Is it too early to expect an incremental boost to cloud demand this quarter, next quarter and beyond?
I think it's too early, but I think the basic premise of your question is flat out correct, which is, I think we're going to see broader and broader deployments of generative AI applications, and it's going to be, this competitive intensity is going to be rising. There's going to be fear of missing out when it comes to not the stocks, but in terms of generative AI deployments across verticals. CIOs are going to be responding to the CEOs and being asked, what are you doing to make sure that we don't lose out? And so what I think that means is you're going to see overall rising tide for all kind of the major cloud vendors. That's Azure, AWS, and Google Cloud. Now, far and away, the 2 biggest providers here are AWS and Azure, but Google Cloud should benefit from this too. That's going to lead to greater need for cloud compute and greater need for cloud storage. It's going to be a secular driver for cloud growth that has slowed over the last year and a half. So you're going to see this re-acceleration in cloud growth, but I think that's going to be clearer in 24 than in 23.
3 stocks on the screen right now: Alphabet and Microsoft. Alphabet and Microsoft after the close. You mentioned Meta. That comes after the close tomorrow. Year to date, Mark, you know these numbers well, up 146%. To hear you say you still like this name after gains like that gets everyone's interest. In your research, you talk about how maybe the current multiple provides some downside protection to an earnings miss tomorrow. Mark, for the people that haven't had the luxury of reading your research, could you explain that to people?
Yeah, well, look, an earnings miss is an earnings miss. Meta would correct probably materially on an earnings miss. Same thing with Google. I do think the bar is lower for Google. I think expectations are a lot lower, but I also want to put this in context. After this dramatic rise in Meta shares, it's trading at 17 times GAAP earnings. It's essentially trading at a market discount, S&P 500 multiple, or a slight discount to that. I don't think it should trade at a discount. I think Meta deserves to carry a 20 PE multiple, 20 times GAAP earnings next year's number, because I think that's pretty close to what the earnings growth algorithm is, that the earnings growth outlook is for the company for the next couple of years. So that massive rise in the stock year to date, the context you have to have as an investor is it massively imploded last year. But fundamentals are improving. You're going to see accelerating revenue growth, margin expansion, they're buying back a lot of stock. And that I think it gives you a lot of support for the stock. I know the bar is going to be higher as we go through earnings season. We've already seen that with names like Spotify and Netflix. So the bar is higher. It's harder for the stocks to really trade up on earnings, but core valuation, I think, for a name like Meta is still highly attractive despite that run in the stock year to date.
Mark, I've got about 30 seconds. I've got to ask you about Threads for obvious reasons. 2 weeks ago, I was told it was booming. 2 weeks later, people are telling me it's failing. Which one is it?
Oh, I think it's growing. I don't know if it's booming, but it's growing. And by the way, 100 million users in a 5-day period, that's truly exceptional. It shows you the power of Instagram and the ability to turn on new features. There's a lot of things they need to do to improve the product, but I think there's a real opportunity here for this to be a lot bigger, a year or 2 years from now than it is today. I think it's another reason to own Meta.
Mark, let's do this again soon. Busy couple of days for you, I know. Thank you, sir. Thank you for giving us some time. Mark Mahaney there of Evercore on the latest with those two names. Coming up over the next 48 hours. Abby, lots to look forward to.
Certainly there is, and right now we have lots of sectors to take a look at. Not surprisingly, with the S&P 500 up just slightly. We only have a few sectors higher. Materials being helped out by 3M, tech being helped out by a lot of the stocks you were just talking about, plus NVIDIA. As for the industrials, they are the worst sector on the day. I know we generally don't talk about the Dow. Yesterday, though, John, 11 up days, the longest since 2017. Let's see if the Dow can turn it around today.
What's the Dow? Abby, thank you. Coming up, your trading diary. Up next.
Like Bloomberg.
The outperformance on the Nasdaq returns, up 0.5% on the Nasdaq 100. On the S&P, barely positive, up 0.1% going into earnings later. That's the price action. Here's the trading diary. Microsoft, Alphabet after the close. Then it's Meta's turn on Wednesday, plus a Fed decision and Chairman Powell news conference tomorrow. ECB rate decision on Thursday. Some US GDP, and we round out the week with the BOJ and earnings from Exxon and others too. From New York City, that does it for me. I'll see you tomorrow morning to build up the coverage towards the Fed decision. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, July 25th. Here are the top market stories we are following for you at this hour. Mea culpa, Morgan Stanley's Mike Wilson says he was wrong as the 2023 rally has defied his bearish call. JP Morgan's Marko Kolanovic, though, sticks to his view that a sell-off is coming. It's just not clear when. Earnings bonanza, the reports come flooding in as GE, GM, and 3M boost their guidance. Spotify and Verizon beat, and Biogen says it's cutting jobs. And two tech giants, Microsoft and Alphabet, come after the bell. And cloudy horizon, the IMF says it's too early to celebrate, even as it raises its growth forecast, with risks still tilted to the downside. We'll speak to the IMF's chief economist, Pierre-Olivier Gourinchard. From Washington, I'm Kaylee Lyons with my co-host in London, Danny Berger. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. And Danny, as the IMF warns of a cloudy horizon, you're not necessarily seeing it in the consumer confidence data.
That's right. We're just getting breaking news on the consumer confidence data from the conference board, coming in stronger than expected, 117. The estimate was for 112. Kaylee, it reminds me of the UMich numbers from not that long ago. The consumer is feeling okay.
Yeah, pretty resilient even in the face of all of the tightening of policy we have seen and continued inflationary pressures, though maybe the consumer is being helped by the fact that inflation is starting to cool off. Let's get more on these consumer confidence numbers now. Bloomberg's Michael McKee is joining us. So Mike, break it down for us. Just how strong is this data?
Well, you look like you're dressed appropriately, very cheerful for this kind of data. As Danny mentioned, 117 for the headline number, which is up from 110.1 the prior month, a slight revision there, but still a very strong gain. Present situation, 160, up from 155.3, and the expectations index rises to 88.3 from 80. So strength across the board, and when you look at the underlying numbers, you see the same thing. We have an increase in the number of people thinking that business conditions are normal. A little slight decrease in those who think it's good, but we have an increase in the number of people who think jobs are plentiful and jobs hard to get is dropped to 9.7 from 12.6. So right now, people still think they can get work. 6 months down the road, 17.1 think business conditions will be better. 14.6 was the prior number, and about the same, 68.9. So people think that things are going to hang in there. Incomes, they think, will not increase, but not significantly decrease either. And in terms of buying plans, people are going to buy automobiles, they're going to buy homes, and they're going to buy some major appliances, but not all. So all in all, a pretty good optimistic report from consumers these days.
Considering the consumer is feeling strong here, considering that the labor market is sticky, Mike, this plays into this battle I'm sure the Fed is going to have this week. At what point is it victory on inflation? Do you need to wait for consumer confidence to change, for the labor market to change? Does this cloud the picture for the Fed, these types of numbers, Mike?
Well, it doesn't make it any easier. Now, the consumer confidence and sentiment numbers don't have a direct correlation to what's going to happen with consumer spending. Alan Greenspan famously said, we watch what they do, not what they say. However, there is something of a correlation between the conference board's jobs hard to get, jobs easy to get numbers and what happens with employment. So it does suggest that perhaps we're still seeing a fairly tight labor market because there are plenty of jobs available and not enough people taking them. So that may play into the Fed's thinking a little bit as we go forward.
Okay, Mike, thank you very much. That's Bloomberg's Michael McKee, a busy 488 hours ahead of him. All right, let's get instant analysis now and bring in Dana Peterson, the Conference Board Chief Economist. Dana, thank you so much for joining us off the back of these strong numbers, stronger than expected. What do you think accounts for this resilient consumer?
Well, I think consumers are definitely happier, not only now, but they're also thinking about the future. And I think a big part of that is labor markets. Most people are working. People have experienced some kind of increase in their wages. Some people have quit and found better jobs. And certainly we've seen people being supported by leftover excess savings. And so combine those things plus lower inflation, consumers are saying that they're happier and they have less reservations in terms of there being a recession going forward.
Well, to that point, Dana, if this really is more about the resilience of the labor market than necessarily the trajectory of inflation, if we do start to see inflation getting closer to that 2% target and those price pressures easing, but the cost of that eventually is more slack in the labor market, is that kind of the worst case scenario for the consumer?
Well, not necessarily. We think that the labor market's going to remain pretty tight. And again, it's due to those labor shortages. And also, we're finding in our CEO confidence survey, many businesses are actually hoarding labor. They're holding on to people. So that also supports, I think, the optimism among consumers, especially with respect to labor markets, where they're not really fearing that they'll be let go. Meanwhile, we do see inflation coming off, headlines coming off for food and energy, and we're seeing some improvement in those core measures away from housing. And certainly we're expecting rents to start coming off any day now.
There always seems to be this concern that if we get any change in the energy price, that all of a sudden that's going to mean inflation. I feel like the same is true with the consumer and gasoline prices, Dana. We've seen it pick up a little bit, some idiosyncratic issues there. If we do see some energy prices start to increase, how sensitive is consumer sentiment to that?
Well, certainly our inflation expectations gauge for 1 year forward does reflect what happens with gasoline prices. But again, people remember what happened last year where gasoline prices were $5 and $6, and we're not experiencing that this year. So a few cents rise, people might not like it, but I don't expect that they're going to be as upset about it as they were last year, which certainly showed up in the inflation expectations gauge, which rose to the highest that we'd ever seen.
Yeah, and we know that the Fed has been watching inflation expectations incredibly carefully as it thinks about how much further it needs to tighten policy. Dana, in that regard, when we think about the transmission mechanism of those higher interest rates, of the tighter policy, we saw it seemed, in housing, and yet we are seeing a rebound in housing at the same time. Are consumers now less reluctant to make some of those big purchases? What explains to you the housing comeback it seems that we're seeing materialize?
Sure, when I look at housing, it's coming back from a very low level. And certainly we're still potentially at the bottom and just kind of moving around towards the bottom. So I don't really see a big revival in housing activity happening now or even until interest rates fall materially. Now, we know mortgage rates have come off a little bit. But the big gains must come with the Fed funds rate. And we're not expecting the Fed to start cutting interest rates until maybe second or third quarter of next year. So I don't really anticipate much activity in housing. When it comes to other types of spending, yes, interest rate rises affect demand for durable goods. And certainly, when I look at the goods purchases expectations or plans in our measure, I kind of smooth it out over several months because month to month it's very volatile. And when you look at the smooth 6-month average, it's trending lower. But the key thing is that consumers are still buying services. And we actually had a special question this month where we asked consumers, what are you buying in terms of services, in terms of what do you think you're going to be buying in the future? And certainly they're saying we're going to continue buying services. But the key thing is they're indicating that they're going to buy fewer things that they want versus things that they need. And I think that's important for the Fed.
Yeah, it certainly is. Things that they want, some discretionary spending. Dana, how much of this is also about the richest of households? I'm looking at the table right now and looking at the huge leap those getting paid $125,000 and over made in terms of sentiment. How much of this is being led by the upper echelons of American society in terms of pay?
Well, it's interesting. When you look at the data, we also saw increases in expectations, or rather confidence, among the lower income persons. It was really in the middle those making between 50 and 75,000 or 50 and 100,000 that weren't very happy in the month. So it's really, there's kind of a hole there. And I think that's probably still the inflationary pressures that consumers are still feeling, even though they expect that inflation's going to be falling. So I think that we need to continue to watch these numbers by income, because certainly at the lowest end and the highest end, people are okay and they seem to be happy, but it's that middle that seems to be having an issue, at least in the month.
Yeah, and we need to keep an eye on that entire spectrum. All right, 2-year high in consumer confidence. Thank you so much for joining us to break it down. Dana Peterson, the Conference Board Chief Economist. Coming up next, we will turn from the conversation around the consumer to the conversation about these markets with our question of the day. Were the bears wrong? Joanne Feeney, Portfolio Manager at Advisors Capital Management, will join us next. This is Bloomberg.
Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come?
Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
All right, we have to talk about Mike Wilson's mea culpa. The Morgan Stanley chief U.S. equity strategist putting out a note yesterday essentially saying we were wrong. Remember, Mike Wilson was right about his bearish call in 2022, but it hasn't worked out so well for him in 2023. He said, quote, 2023 has been a story of higher valuations than we expected amid falling inflation and cost cutting. At the same time, Mark Goklanovich over at JP Morgan is sticking with his bearish view. He says there's going to be a sell-off, but he can't exactly pinpoint when. He acknowledges that at this time, an inflection point near term, there are no data points that would prompt us to change our methodology or conclusions. So this brings us to our question of the day. Were the bears wrong? Or maybe are they just too early? Joanne Feeney, partner and portfolio manager at Advisors Capital Management, is joining us now. So, Joanne, what's your answer? Did the bears just get this outright incorrect, or are they just waiting for their time to come?
Well, I think they would argue they're still waiting. And, you know, a few things happened this year, really, to save the market from the bear narrative, right? One was that inflation fell maybe a little bit more rapidly than people expected. Two was that the labor market remained far more resilient amidst consumer spending that remained very strong. And three, we had this thing called AI show up on the investor radar screen late last year that suddenly raised longer-term growth expectations for a whole set of companies. And those three things drove up valuations and have really saved the market from the more bear view that rising interest rates would constrain economic activity and slow down growth very severely this year.
Joanne, can I ask, and also, you know, digging into your experience from the sell side too, how useful is it to get the advice that at some point this market is going to sell off? Isn't that kind of like saying at some point it's going to rain? Like, obviously it's going to happen at some point.
Yeah, exactly right. And, you know, we at Advisors Capital, we also have been trying to craft our macro view, and we keep having to push out our recession forecast. For us, it's always been, you know, at least 6 months away. So while we've been a little bit defensive in positioning our portfolios, mostly we've been, acknowledging that consumer is going to remain stronger than the market expected. We owned the housing space. We owned some automobiles. We owned some tech because we really didn't see things falling off a cliff. So yeah, that view that, hey, at some point there's going to be a recession should kind of always be in the back of your head as an investor, and one should always design portfolios with some defensive positions because you just never know when the business cycle is going to change.
Yeah, and we've been focusing obviously on when and if a recession is going to come, what that may mean for corporate earnings. But Joanne, I want to point to kind of the second part of Mike Wilson's note where he essentially says inflation falling even faster than consensus could be a problem when it comes to pricing power that companies have. Should we be more concerned about that aspect if we get the scenario in which inflation is rapidly falling and yes, growth is hanging in there, but what does that mean for corporate America, especially if it also means that the Fed's staying higher for longer?
Yeah, I would just reverse the logic there. Inflation isn't this exogenous thing that just happens and companies have to deal with it. Inflation arises because companies choose to raise prices because they can get away with it. What we're seeing, right, is that companies raised prices for a lot of the last few years as supply chain drove up costs and consumers had more money in their pockets because of the stimulus. And now what we're seeing is that pricing power is diminishing, which it should do over time. Consumers can only pay so much more over time, and so companies can't raise prices as much as they used to. We do expect that to constrain margins, and that's why we're seeing so many companies now try to cut costs in order to preserve margins to some degree. So yes, absolutely, we should expect pricing power to run out, and we should be watchful of how that's going to affect margins.
I just wonder if it gets bad enough if pricing power runs off that we return to last year, because of course last year's bad risk environment was all about the macro. What needs to happen for that to replay out again? Does something need to go wrong on the macro front, or can it be what you're describing with earnings to get as ugly of a year for risk assets?
Yeah, so I think the risks this year are twofold. One is, as you said, both the macro side, because I think the markets, might be a little bit too optimistic about what the Fed needs to do to solve the inflation problem. Everybody expects the Fed to raise rates by 1/4 point this week. I think that's pretty much baked in. The question is what happens for the rest of the year, and that's still an open question because there's still a lot of data that the Fed will see before they have to make a decision in September and then again. But I think the market is thinking, okay, this is it, we're done after this rate increase, and then they expect rates to be cut. I think that's probably too optimistic, and the fact that real interest rates are rising as inflation comes down, as those nominal rates stay high, that becomes a bigger headwind to economic activity. So there is a macro risk out there that perhaps people aren't acknowledging. And then secondly, earnings. As I wrote in our commentary for this week, the market is precarious right now. There has been such a run-up in so many different stocks. 230 stocks are up more than 10%, and the average of those is up 30% year to date, with dozens of companies trading at a market multiple, well above 30 times. So this is precarious. There's a lot of growth expectations built in, and any slight change in those growth expectations as companies report, as we saw last week with Netflix, for example, and Tesla, is going to lead to very significant adjustments in stock prices. So I think those are the two sources of risk in the market right now, which is why I think you still want to own some of the best companies that are going to drive U.S. and global economic growth. It's okay to own things like Microsoft at these prices, for example, but you also want to own some defensive companies because we do think there's likely to be a reset in many areas of this market.
Okay, well, you just mentioned Microsoft, Joanne. Obviously, it's going to report after the bell today. Same with Alphabet. Both of those stocks up around 40% year to date. How high is the bar for them? How great is the risk that they cannot deliver and meet it?
Yeah, it's pretty hard to tell. Remember, they were down a lot in last year, so a lot of this is just recovery. And their multiples, are high, but they're not, to the stratosphere. So those are actually pretty solid things to continue to own. The risk is that there's so much hype about AI, generative AI, and the role that the Googles and Microsofts and Amazons of the world and NVIDIA will play in enabling AI, that there's a lot of expectations for much faster growth for longer. So the question is, how much of a short-term view does the market take when these companies report? They're only going to tell us what they did last quarter. They're going to give us some guidance for the near term. But what we're seeing in the market is an expectation increase for longer-term growth, which is why valuations have come up so much. The market PE above 19.5 reflects expectations of growth, not for the next 12 months, but for the next 2, 3, 4, 5 years. So if companies don't signal that they're on track to see growth remain elevated, if Microsoft's cloud business doesn't indeed bottom this quarter as expected and start to re-accelerate, I think there'll be some disappointment. And that's really the concern, is the longer-term growth outlook.
Joanne, really great to get your thoughts ahead of, at least for this very moment, feels like a calm ahead of a storm with all those earnings and rate decisions. Joanne Feeney there, thank you so much, partner and portfolio manager at Advisors Capital Management. Still ahead, big tech earnings, as Kaylee was just saying, are on their way. Microsoft, Snap, Alphabet, all set to report after the bell, rather. We're going to have all the details on the AI play in the startup next. This is Bloomberg.
It's 23 past 7 on the West Coast. Let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Anurag Rana of Bloomberg Intelligence. And Anurag, it's morning time in Silicon Valley. It's going to be quite a long day for Silicon Valley because we're waiting for some of its biggest giants to report after the bell, Microsoft included. We were just having a conversation in the prior segment about just how much this stock has run up this year. About 43% gain, I believe. What does it have to deliver, and can it do it?
So for the first time, I think, cloud numbers are going to be the most important one, both the current quarter results as well as their guidance for next quarter, because, on one end, we are seeing a lot of increased workloads because of ChatGPT. On the other side, we have technology spending going down. So those are the two counterbalancing forces, and we'll see which way, the wind blows tonight, because, it is going to be important. Cloud is the only thing that benefits directly in the near term for Microsoft, because all the AI products are going to take some time to, be launched as well as monetized.
But how does it set us up, Anurag, if we have a price to earnings ratio, P ratio at 32 for Microsoft, Apple is 30? I mean, these are some numbers. What does that mean to have this rich of a valuation before they reported?
I think the promise of AI is pretty wide and large, and Microsoft has a better story than any other software company right now. So, in my view, even if they miss the numbers tonight, I think investors may give them a pass because their AI story resonates better than any other software company right now.
Okay, fair enough. And obviously, Anurag, this is going to set a tone, I would imagine, for the rest of the big tech giants, that report. Just thinking about the risk posed to the broader market, how much up or downside volatility potential could we see?
I mean, there could be much because, as you said, the valuations have run up quite a bit in the last 6 months. For Microsoft, for example, you mentioned that the stock's gone up quite a bit this year, but estimates are down, I think, slightly 1 to 2% in terms of revenue growth rate. This is the first year where Microsoft will have, fairly, I would say, anemic revenue growth rate compared to the last 5-6 years, where growth rate has been 14 to 15% in constant currency. That's pretty healthy, and this is the first time you're going to see a bit of muted results from them.
Anurag, 30 seconds. What earnings are you most worried about?
Worried about, I think Microsoft is going to be the most closely watched because it's going to set the tone for the entire software space, which has had a massive run over the last, 3 to 4 months. I think any hint of slowdown in cloud, even in next quarter, could be worrisome for the entire sector.
All right, Anurag, thank you very much for that excellent setup. Anurag Rana there of our Bloomberg Intelligence team. Coming up, the IMF lists its global growth outlook. Pierre-Olivier Gourinchas, IMF chief economist, will join us next for all the details. This is Bloomberg.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, it doesn't look like anyone's looking to take any real position ahead of big tech earnings today.
Yeah, I would agree with you, Kaylee. We do basically have small moves. Before we take a look at those small moves, let's take a look at an index that we usually don't look at. This is the Dow, but over the last 12 days, climbing all 12 days at this point for a roughly 5% gain. So it's interesting to see this sort of outperformance by the Dow in recent days. Not quite sure what that means. Perhaps some diversification or some nervousness before these big tech gains. This is the best winning streak, longest winning streak, I should say, since 2017. As for the small moves, well, we're going to see the Dow's move on the day is tiny, up fractionally. The S&P 500 up a little bit more. The NASDAQ 100 up about 0.5% ahead of Microsoft and Alphabet reporting tonight. And then you can see the stocks really outperforming, up 1.7%. NVIDIA and many other of the chip makers are higher. Now, the story for the year, of course, is this big rally for the NASDAQ 100. But if we take a look at this chart here, this is the NASDAQ 100 with the weighting that it actually has. If you strip it of the Magnificent Seven, those mega cap tech names such as Apple, Amazon, Tesla, so on and so forth, you can see the gain is much less. If we break down today's trading action, we're going to see similar dynamic, because up top, some of the biggest point boosts for the NASDAQ 100, well, they are NVIDIA and Microsoft, a very nice gain for NVIDIA. But then take a look at PACCAR, the car distributor, manufacturer, had been down, I think, more than 10% earlier, the worst day at that point since 2011. They missed some of their numbers. And then Sirius, the short squeeze, well, Danny, it's not really happening so much anymore. And the stock over the last 3 days down about 30%.
All right, Abigail, thank you very much. Bloomberg's Abigail Doolittle there. Thank you very much. Now, the IMF is seeing signs of progress in the global economy. It's raised its global growth forecast for 2023 from 2.8% in April to 3% in its latest report. Joining us now is Pierre-Olivier Gornisha, IMF Chief Economist. Thank you so much for joining us. Look, I love what you write here. There are clouds on the horizon, and it is too early to celebrate. Tell me, what is the biggest threat to ruin the party here?
Well, the biggest threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit. I mean, there was quite a bit of resilience in the global economy, but especially in the first quarter. But, you know, the momentum is slowing down, and this is why, at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth. But behind this, what we're seeing is, well, of course, headline inflation is coming down because energy prices are coming down, but below the surface, if you look at underlying inflation, core inflation, it's proving more persistent. And that persistence is a real challenge. It means that, you know, central banks, monetary policy needs to remain in contractionary territory, needs to weigh on economic activity to bring inflation back to target. So that's clearly the main focus, and should remain the main focus going forward.
Well, and the question remains, Pierre-Olivier, whether or not central banks doing so, keeping policy tight to get inflation back down to target, is ultimately going to come at the cost of a recession. And as you talk about growth that is moderating, even moderating growth is still growth. Take your forecast for the U.S. specifically. I believe 1.8% growth this year, 1% next year. Is it your anticipation that we avoid a recession here, that the Fed can achieve the soft landing?
That is right. I mean, a recession is not in our baseline forecast at this point, so it's a very narrow path, of course, because when you get to a growth rate of about 1.1% for, as we have for the U.S. for next year, you know, this is a fairly low growth rate, and it wouldn't take necessarily much of a shock, you know, external shock, increase in energy price or whatnot, to knock that trajectory off its rails. So here, in a sense, what we're saying is it's a narrow path, but it's achievable. What we're saying is slowdown of the economy. We're seeing good news on the inflation in the sense that core inflation remains high but is expected to decline. We're seeing monetary policy weighing down on the economy overall as it's expected to be, as it needs to do. And so if we can stay on that path, then we're avoiding a hard landing.
What about Europe? You wrote that the euro area is set to decelerate sharply. How sharp could that deceleration become? Could we look at not just a slight recession, but a more troubling recession?
Well, the slowdown in the euro area is certainly much sharper. We are projecting that growth will come down from 3.5% last year to 0.9% this year. So this is quite a bit of a slowdown. But there's a lot of variation between European economies when you look under the surface. Some of the sharpest slowdown is in Germany, for instance, while some economies like Italy or Spain are doing better than expected. And what's driving this is really how global demand has been rotating away from goods and into services, including tourism. So countries that are big manufacturing countries like Germany are suffering more, and countries that are tourist destinations are doing slightly better.
Okay, as you talk about services, Pierre-Olivier, obviously that is a lot of where the pricing pressure has come from, that sticky services inflation proving very, very persistent. As we talk about the degree to which inflation has come down, granted everything you said about how far it still has to go, can we really attribute central bank policy to being the reason why, or is it the easing of some of the supply side challenges we were facing that is the primary driver? And if that's the case, when central bank policy actually kicks in to do its job, where does that leave us?
Well, so I think there are different channels through which monetary policy is playing a role here. So first, it's clearly the case that, some of the moderation in energy prices we've seen over the last 6 months or so is also in part because the global economy is slowing down, and that's also related to tightening of monetary policy. As everyone is sort of spending less, there's less demand for goods, as just described. There is also less demand for energy to produce these goods or ship them around, etc. So we see some effect of monetary policy there. A second very important effect of monetary policy is that central banks have been able to keep inflation expectations very well anchored in the medium term. And so here you have to ask yourself, what would have happened if central banks had done nothing and we had this huge increase in inflation rates, and seeing nothing being done, households and firms would have started expecting that this inflation could continue in the future, and that has not happened. Why? Well, because central banks got in and tightened monetary policy, and that has helped contain actual inflation. And the third part is the one you mentioned on services and the impact of monetary policy on the broader economy. We're starting to see signs of monetary policy cooling off activity now. We're seeing interest expenses increasing. We're seeing loan demand decreasing, loan growth coming down quite sharply in a number of countries. So we're seeing real estate markets also feeling some pressure. So these are all the traditional channels through which monetary policy is acting on the economy, and they are all in play right now.
Europe, a great example of that, Pierre-Olivier, with the biggest drop on loan demand in record. We saw that data today. Can we ever get back to 2% inflation, or is equilibrium changed? Has something fundamentally changed with this global economy?
We don't think that something has fundamentally changed. I mean, we will have, in our projections, we will have inflation coming back to central bank targets sometime towards the end of 2024, in 2025. So it's a little bit delayed compared to what we were expecting earlier, and that's this persistence of inflation that we're talking about. But we're still seeing it coming down eventually, within a year and a half or so to central bank targets. Let's remember that central banks have the tools to bring inflation back to their targets, and of course they want to navigate this and do it in a way that doesn't crash the economy. The objective is not to crash the economy, it's just to keep price stability.
Right. Well, while we're talking about trying to get to 2% inflation here in the U.S. and Europe elsewhere, we have to talk about the inflation levels in one country in particular, Pierre-Olivier, Argentina. You are forecasting 120% inflation. Is there a real risk that they reach hyperinflation levels if things continue on this trajectory?
Well, Argentina, we've had a significant upward revision of the inflation rates, and of course it's a very challenging environment. It's an environment that's challenging for a number of reasons, one of which, which of course is very difficult to deal with right now, is they are facing a very severe drought. And so the agricultural production of Argentina, and Argentina is one of the major agricultural producers in some of the crops, has been severely lowered for this year. And so that creates a very challenging environment. Inflation numbers at that level is always a very, very worrisome sign. And what we are doing is working with the authorities and trying to make sure that we have in place policies that will prevent inflation from escalating from this already very high level.
Well, there's also the question if it's $44 billion loan, which the IMF is currently talking to Argentina about this, a current review. If it is approved on the staff level agreements, what sort of payout could we see from the IMF to Argentina?
Well, these discussions are ongoing, and I think it's a little bit premature to comment on them right now because they're really happening as we speak. But let's just say that there are conversations between the authorities and the International Monetary Fund. They are trying to find a package of measures that will be helpful for Argentina and will take into account the specific circumstances that are affecting the country, and will try to put the country on a firmer path